Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, and regulatory landscape in capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market site is Jim Caron, Chief Investment Officer of Cross Asset Solutions at Morgan Stanley Investment Management, Sandip Bhagat, Chief Investment Officer of Whittier Trust, and Brian Joyce, Managing Director on the Nasdaq Market Intelligence Desk. We're here to discuss the potential dominance of fiscal policy over monetary policy related to taxes and spending well into 2025. It's great to have everyone with us. Welcome back. Jim, it's a great point that you bring up in your notes here. We're really thinking about fiscal policy, not because we're bored of talking about monetary policy, but really this is what's going to move the needle, I think.
I think so too. Look, I mean, when people ask me what's going to keep you up at night, I think that fiscal policy and where we're headed over the next 18 months plus is going to be a big deal. So what we know in 2025 is that a lot of the tax cuts that were put into place in the first Trump administration effectively will start to unwind. And whether it's Joe Biden or Donald Trump in the White House, this is a big problem. So right now we have a fiscal deficit of around 5.5% of GDP. It's too high. If you just look at the interest expense on this going forward, it's going to continue to move higher. Even if you kept spending at the federal level the exact same as where we are today for the next 10 years, the deficit's moving higher just because the interest expense is going to be there. So the question for us is, how do we actually address that? Well, you could have higher growth, higher productivity. That's the best way to do it. Or you could be in a position where you have to go into fiscal austerity, which means less spending, which could create more volatility in the economy. Then the dollar comes into play here too, because people who invest in U.S. assets, particularly U.S. Treasuries, might want a bigger discount, so therefore higher yields in order to do that. So it creates a whole myriad of problems, and as I like to say, there are no fiscal policy futures. We have monetary policy futures, like Fed funds futures, but there's no real way to hedge this in the markets, and that makes it also very difficult.
Right. Well, Sandip, I mean, how does the Fed approach this then? I mean, even if they were to cut one or two times perhaps in 2024, is that really going to move the needle in terms of managing fiscal policy?
Actually, the timing of the Fed rate cuts simply doesn't matter anymore, and we have seen that so far in 2024. Expectations were for 6 rate cuts. They're down to 2 by December, and yet the S&P 500 is up over 15%. So we have unusually resilient economic growth, and that is now leading to a new way of thinking about future Fed policy. And central to this line of thinking is the concept of the neutral rate. So a quick definition very quickly: the neutral rate is that equilibrium policy rate that allows an economy to grow at its full potential growth rate at stable inflation. In other words, at steady state, it is neither expansionary nor contractionary. Now, many contend that the US economy's neutral rate has gone higher. The Fed stands at 5.4%. If that neutral rate is higher, that means there are fewer rate cuts ahead of us. And there is a school of thought, in fact, the overnight swaps market is pricing this rate to be as high as 4%. The Fed's long-held view on the neutral rate is 2.5%. They have ratcheted that up to 2.8. I personally believe the neutral rate is higher, but really it's in that 3.25% range, and is driven by 2 factors. Inflation will end up being higher than what the Fed is targeting, and productivity growth will cause the US economy's potential growth rate to go slightly higher. But we're not talking 2.5, we're certainly not talking 4, and the distance from 5.4 to 3 and change is still 8 or 9 rate cuts that lie ahead. And as long as the market can anchor on that outcome, the speed and the trajectory in between just doesn't matter.
Right. I mean, is that a good thing though, Jim? I mean, the Fed doesn't have to do anything?
Well, you know, look, I mean, I think it gives the Fed some optionality to cut interest rates. And, you know, as we're discussing, there are rate cuts that are expected into the future, but it's also a question to me as to how the markets will actually react to that. So will bond yields go down materially based on that? And I think that we've come through a period, let's call it from 1981 to 2021, where the Fed could cut rates and they could actually keep bond yields down for an extended period of time because inflation was coming down. If the neutral rate is higher today than what it was in the past, effectively what we're saying is that we likely have a higher inflationary environment that we're in today. So in other words, if the old inflation target was 2%, we couldn't get above it. I think today that inflation target of 2%, it's going to be hard to get below it for any material period of time. So you may have to have a higher neutral policy rate in order to adjust for this. What this suggests, though, is that even though the Fed may cut rates over time, say into 2025, 2026, and beyond, 4, 5, or even 6 times, the question to me is, where does the 10-year yield go? Right now, the curve is inverted, right? So does the curve then start to re-steepen? If it does, if the curve goes from minus 30 basis points where it is today, 2s to 10s and treasuries, and if it goes to a more natural place like plus 50 basis points, then maybe the 10-year yield isn't able to go down as much in yield as what it had in the past, and therefore bonds are less of the effective hedge to equity and to everything else that they were in the past. So that's where we are.
So Brian, let's take a look at this from a technical perspective and how the markets are interpreting the 2s and the 10s to see if this aligns with fundamentally what we're thinking or if it suggests otherwise.
So here we're looking at the 10-year, the 2-year Treasury yield, and we can see that it's back to this 4.75%, which right now would be roughly 3 cuts, but this is 2 years out. So it's certainly, I think the market is at 2. It's actually more dovish than what the Fed is. The Fed just recently moved to from 3 cuts to 1 cut this year. So we're this was a top back in late 23, and then we tested it again in February, March, and April. From below and then back above it. So it's been a repeated level that the 2-year seems to navigate towards. It's now coinciding with the 200-day average. If we flip to the 10-year yield, we can see, as we were just alluding to, that it is trading higher. So we have a brief steepening taking place between 10s and 2s over the last week or so. It's still, in my eyes, in a downtrend from its high in April. It does coincide with the economic data. So when we look at the Citigroup Economic Surprise Index, we can see that's been trending lower. It's at 2 years lows we haven't seen since the summer of 2022. So maybe markets are now anticipating that weakening data, and employment numbers seem to be at somewhat of an inflection point. We're already at 4%, which is the Fed's year-end target. And so I wonder if we're going to if that is going to drift higher, will the Fed come off the sidelines and potentially at this upcoming meeting in July signal rate cut in September?
Right.
We'll have to wait.
It was remarkable how the 10-year bond market reacted to both the presidential debate and just pricing in a greater probability of a Trump win. Neither candidate has shown any fiscal discipline. And so there are now serious questions about fiscal sustainability, and that's affecting the 10-year bond yield, Jim, like you suggested. Yep. If it is a Trump win indeed, at least this fiscal spending in the form of a suspension of the tax cut expirations will at least be stimulative, right? So there is a growth component that is affecting the real yield at the 10-year level. And then there is a risk premium from the sheer lack of fiscal discipline and an outsized deficit.
Well, I wonder the way the market's interpreting it. We know the incumbent is going to open up fiscal spending, the purse. I mean, that's historical precedent there. And the market also knows how both candidates think in terms of spending and where they want to allocate resources and what policies are helpful to which market or the other market. But I want to ask you, Jim, what about the US dollar? How does fiscal monetary policy impact that? Is it influenced beyond just that type of policy?
Yeah, so both, as you're mentioning, both presidential candidates, let's say, are going to spend until the market stops them from spending, right? That's what presidents do. That's what politicians tend to do. The issue is ultimately is what happens to the dollar, right? In theory, if you're running a high fiscal deficit, your currency should weaken. Now, the dollar has been strong, right? So that's sort of flown in the face of a lot of these things. But if the spending continues, if you're running excessive deficits for an extended period of time, and this becomes the new normal, the currency will effectively adjust. So I would argue that I'm not making a call that the dollar is going to go down or anything like that. It is strong at this stage. But what I am saying is that on the margin, as time goes on, what it suggests is that more foreign buyers of U.S. assets are going to demand a higher and higher risk premia to account for the fact that we have this very large deficit. which means that bond yields will be, in central bank speak, higher than they otherwise ordinarily would be. So what does that exactly mean? How do we quantify it? Very difficult. But what it suggests is that in this environment where we may need stimulus, let's say we go into a slowdown, we need some stimulus, we need yields to go down, the ability for the Fed, the ability for the Federal Reserve or any central bank or even the federal government to create policy where interest rates can go down might be somewhat impeded by the fact that they've got this deficit and people demand, particularly foreign investors, demand a higher risk premium, so therefore higher yields. So at the margin, I think it weakens the ability of the Fed to have a counter-cyclical policy response as effective as it had been in the past.
Right. So Brian, let's take a look at the technicals again as it relates to the U.S. dollar.
So here we're looking at the U.S. dollar index. So it's a basket largely weighted to the euro and the Japanese yen. We know the yen has been weakening to multi-year lows, and so that's been providing a tailwind below the greenback. We're now trading back above its 200-day moving average, and we're well below the levels we saw in late 22, and we peaked most recently when yields peaked back in April, and so that was off below the highs that we saw in 23. And now the April highs versus where we are today, we're right at that level. We're connecting that those prior tops. There's a declining trend line there. So I think we're at an inflection point here with the dollar as well as rates, where they're both kind of testing the upper bound of recent resistance levels going back to the fourth quarter of 23. And I think, determining based upon maybe what we could see at the upcoming Fed meeting may determine and be the catalyst to see whether or not rates can break out higher, whether or not the dollar can break out higher, and that certainly I think will have an impact on equities and the different industries and the different sectors of the market and the potential rotation that we see coming down the pipeline.
So let's stay with the charts for a moment here as you're talking about inflection points, as we saw with rates, as we saw with the dollar. We're coming into earnings season, and there's this narrative about the bifurcation, whether it's in the economy or the market, where you have a handful of stocks. We're looking for that breadth to widen out. Can you tell us, are you seeing in the charts that it's also at an inflection point when you think about how breadth is widening or other sectors that could potentially participate?
Absolutely. So we certainly seen limited breadth, limited performance in the second quarter versus the first quarter. In the first quarter, we were just coming off 5 very strong months. It was the top 5-month rolling performance for the S&P 500. I should say top 10 5-month performance going back to 1970 for the S&P 500. Back-to-back quarters of double-digit gains. Historically, that does bode well for future performance over the next 12 months. Here's a chart showing the S&P 500 equal weight index up 27% from over that 5-month period. The mid-cap index up 32%, both hitting new all-time highs. And so those two indices, which I think represent a good breadth of the economy, have since been in a sideways consolidation mode. And since in the second quarter have been underperforming. Really what's been doing well most recently is that large cap growth that everyone's been talking about. So how the dollar performs from here, how rates perform from here may determine whether or not these types of indices, the equal weight, the mid caps, resolve to the upside or break down below.
All right, well, Sandip, let's talk about that. Let's talk about earnings. Are expectations too high? Are valuations too high? Is there too much hype in the market?
That was the big concern going into 2024. Earnings had stagnated for the last 2 years, and suddenly the consensus was calling for double-digit increases in both 24 and 25, and people were just highly skeptical about that. That was a big question mark. Now the market has climbed that wall of worry, and remarkably, typically what happens over the course of the year, earnings estimates begin to come down. Analysts generally tend to overestimate. Not only has that not happened, earnings expectations are actually going the other way for 24. They're up a smidge. For 2025, the growth rate has gone up by a full percentage point. And so, look, every time in the past when earnings have stagnated, they do snap back to the normalized level of earnings, which still stands significantly higher than the estimates currently hold out. And if that is just too empirical or numerical, the most fundamental way to think about it is inflation in 24 and 25 will be a lot lower than it was in the last 2 years. When inflation goes up, the higher cost of labor and raw materials, your input costs, cause margins to compress. it works exactly in the opposite manner when inflation begins to come down. Those costs come down before your selling price, margins expand, and that's your key fundamental driver for why earnings will be intact and they're not too high.
Yeah, well, I mean, Jim, thinking about it in 2024, we didn't get to the 6 to 7 rate cuts. Companies have been managing a challenging macro environment, higher rates for longer, quite well. So, you know, there is something to Sandip's point there, but when you think about you have to add the election into the calculus as well, what do you think the impact could potentially be there? And then what sectors do you favor? Are there any implications for that?
Yeah, absolutely. Look, I mean, Sandip is hitting it right on the head there. The market's following the money. The earnings have been getting better, right? So effectively, this is what's driving a lot of this. So I wouldn't view this, you know, some people are quick to say, oh, this is a bubble, this doesn't make any sense. No, it makes perfect sense. I mean, the earnings are getting better, and they're better than what people thought. And that's why the first half of the year has returned, if I look at the S&P 500, it's returned about 15%. So the broad markets have done very well. And the earnings revisions look like they could potentially continue to grow. Now, yes, it is happening for a narrow sliver of the market, that is for sure. So if you look at the top 10 stocks in the S&P 500, that accounts for most of the earnings gain. The other 490, the earnings revisions have been relatively slow. So as we start to move into the election, as we start to think about these things, it's kind of funny when you ask people about this and you say, will the election create volatility and uncertainty in the markets? Most people say yes. If you ask them the follow-up question and say, what are you doing about it in your portfolios? They'll say nothing. So I think that is really what's speaking volumes here. People are following the money. If the earnings are coming in and they're coming in strong, then I think there is a case to be made for continued upside. So if we put some numbers around this, right? So if we let's look at 2025, 1 year ahead forward earnings into 2025 is $277, $278. The multiple, the PE for 2025 consensus estimates is somewhere around 19.7. Where does that put the S&P 500? Puts it around 54.70, 54.67. Pretty much, you know, right where we are today. So I would say that we are trading at levels that I would say are optimistic for future growth. Now, is there a potential that there is an earnings disappointment, that there's a quarter where it's not as good and that some things could correct? Absolutely. But the trend that's in the marketplace today still is still relatively positive. So I would say that as long as fiscal stimulus, as long as fiscal tightening, potentially in 2025, does not get in the way and we're able to make these earnings numbers, we could stay around these levels for an extended period of time and maybe even see some overshoot. But if we do see a bit of a correction, I would view it just as a correction and as an opportunity to buy.
All right, and to wrap up here, Brian, any charts that you want to call out from a technical perspective?
Sure. If we do see that constructive rotation, I would be looking at consumer discretionary this week, which is breaking out from a 3-4 month trading range. The financials, which if we do have a change in leadership at the White House, maybe that regulatory environment improves. Those peaked. They were one of the top performing sectors, believe it or not, over the 5 months from Q4 into Q1, and have since been in this sideways range. So I think they potentially look favorable there as well. And then industrials has also. They were up in roughly 33% over that 5 month window. They've been in now also that same sideways trading range. So those are 3 groups I would look to if there's a constructive rotation we see in the second half of the year.
All right. Look forward to seeing what the trading action is going to look like. There's a great fundamental thesis going on here. Appreciate everyone's insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.